Welcome to this session. Our focus is to discuss on taxation of income of a partnership. Taxation of the income of a partnership. So first we need to define for ourselves what is a partnership. So we're saying a partnership can be defined as the relationship which exists between persons carrying on a business with a common view of making a profit. So if at least two individuals come together to carry on a business with a common goal to make profits, that then becomes a partnership. But then the focus for us today is more on the tax side to a partnership. Then what are we saying? So basically we are saying if there's an association of persons carrying on a business, these are individuals, and they have a registered partnership, then we need to inform ourselves on how the partnership will be then dealt with when it comes to matters tax. Then so first, before we move forward, we need to appreciate one fact, that the income tax has defined the term a person. The income tax has attempted to define the term person for purpose of taxation. And what we are saying, the term person in lay or simple terms basically is that natural person or a body corporate. So for purpose of taxation, when we are subjecting a person to tax, we subject to tax a natural person or a body corporate. So then a natural person in this case is an individual. So for purpose of taxation, we can tax an individual or a non-individual. In this case now, the body corporate. So body corporate could be a limited company, it could be a corporation, it could be an NGO or any other organization which is basically not a sole proprietor. It's basically not a sole proprietor. So of interest to us is we need to ask ourselves whether a partnership falls under the definition of a person. And the answer is no. So partnership does not fall under the definition of the term person for purpose of taxation. And so that implies that we don't tax a partnership, or rather we don't assess a partnership for taxation. But then we look at how to deal with the income, the business income for a partnership, and how it's taxed shortly. Then before we do that, we need to appreciate some salient features, features of a partnership. We need to appreciate some salient features of a partnership. So number one, of course, we are saying there has to be a partnership deed. Basically, this is the agreement between the partners on how to run their affairs in terms of contribution of capital. It dictates whether there's the issue of capital contribution, there's the issue of interest on this capital. So this partnership deed then will dictate the interest on this capital contribution. It will talk about aspects of drawings. So if there's any withdrawals from the partnership by any member, the deed will guide on those drawings, and specifically for us, we'll be interested on the interest on drawings. Then the other issue is on the profit sharing. It will guide on the profit sharing ratio. And then another aspect which will come in here is the aspect of salaries or remuneration, or whether there are any commissions which are payable to the partners. So this is all stipulated in this partnership deed, this agreement between the partners on how they will run the affairs of the partnership. So once we appreciate that aspect, then we need to inform ourselves, how do we carry out taxation of of a partnership. So we've said we don't tax the partnership income, but then we need to know how to deal with it. So before we do that, we need to then agree that we have two approaches to dealing with a partnership for purpose of taxation. So issue number one is that we need to prepare something called computation of adjusted partnership profits. So we are saying the reported partnership profits has to be adjusted before we proceed. The reported profits. So if we get the statement of comprehensive income, so this is actually from the statement of comprehensive income of the partnership. So the partnership has traded during the year, and at the end of the year, the management has prepared a P&L. So in that P&L, there is a net profit. So this net profit, we're saying we need to adjust it for tax. And how to go about adjusting this net profit for purpose of tax? We are saying, of course, we need to consider we need to subject it to the expenses. So on the expenses side, we need to subject it to section 1516 rule assessment, where here we look at what are the allowables and the disallowables. So we need to adjust in the sense that the allowables, we are saying any expense which was incurred wholly and exclusively in generating the revenue will be allowable. Otherwise, we will disallow as per section 1516. So we'll subject those expenses which are in this P&L, this statement of comprehensive income, to this test of section 1516. On the incomes then, on the income side, we will be assessing these incomes for whether they are taxable or exempt. Whether they are taxable or exempt. So that then any taxable income will subject it to tax, and will exclude any exempt income from this adjustment. And so how do we then go about this adjustment? So what we're saying is, so in the computation, so this is a computation of adjusted partnership profits. So what we'll do, we will take the reported profits, which is basically the net profit, which is in the statement of comprehensive income, the profit and loss account. We will add back. In this case, we'll add back the disallowable expenses or non-allowable deductions. So if there is depreciation, so the normal items depreciation, for example, so say depreciation, we will add back. So for example, depreciation, we'll add back now any payment to the partners, any payout to the partners will add back. So if the salaries to the partners, this is to the partners. Salaries to the partners will add back, but the salaries to employees that is incurred in generating the income will be allowable. So interest on capital paid to the partners, we will add back. Any commissions paid to the partners, we will add back. So apart from the other normal disallowables, we will bring in this payouts to the partners. We'll bring in those payouts to the partners. So once we have the total, so maybe there was tax paid. This is the normal, we'll add back. So then we'll get the total add backs. Then we need to less. So we less, say, capital allowances, which had not been deducted. Capital allowance which had not been deducted. Then we can less now the exempt income. So we less the exempt income at this level. And you can also less any specified specified income as per section 15.7. As per section 15.7, we'll less that, and we'll less interest on drawings. Interest on drawings. This is to the on partner's account. We forgot here, we need to include drawings. So any drawings we'll add back. Any drawings by the partners we'll add back. So that here we less the total items which we've agreed on. So we'll get the adjusted partnership profits. Now with this, so we need to take note of this figure. Let's refer to this figure as our A. We refer to this figure as our A. So we need to take note of this. So this is how we compute our adjusted partnership profits. We will take the net reported profits, we add back the add backs, and less any item which is which had not been considered. Now, after we do that, the next phase for us is to prepare. So we need to prepare what we refer to as partners income allocation schedule. Partners income allocation schedule. So we need to prepare this schedule as our step number 2. So we'll have the partners names. So partner A, say partner B, and say partner C. Then we'll have our totals at the end. So here we're distributing the incomes which were earned by the partners. So for example, assume there were salaries to the partners. So we'll consider their salaries, and we get the totals. We will consider commissions. So assume there were commissions. So we'll have commissions for the partners. So we realize you are allocating to the individual account of each partner. So assume there was interest on capital earned by the partners. So we will consider to the accounts. And remember to put up the totals at the end. Then after we consider all that, we need to consider share of profits. Share of profits becomes now our item number 4. So you notice we started with the salaries, we came to commissions, then the interest on capital, then share of profits. So how do we get the share of profits? So what we need to do, we go to our totals. Here. So we bring in the figure which we arrived at as adjusted partnership profits. You remember the item we refer to as A. That is the amount which we'll bring here. Then we'll take our figure A, then we less, so we forgot to consider before we do that, we need to include interest on drawings. There's interest on drawings. So the interest on drawings, assume partner C had interest on drawings. So there is none on these other two. So before you get the share of profits, so we need to take the total here, A, which is equal to adjusted partnership profits. Then we less these other items. So the balancing figure, see this then becomes a balancing figure. So the balancing figure is what then you allocate to this figure is what you allocate to the partners in their sharing ratio. So you will allocate to the partners in their profit sharing ratio as per the partnership deed. So with that, if you do that, you get the share of profits. Then with that, we get the business income. The business income for each partner. We get the business income for each partner. Once you get the business income for each partner, we look at whether this these partners had other incomes, say farming income. So you may find partner B has a farm and is getting a farming income. Maybe another partner is declaring the spouse's income, so we'll include that other income. Maybe another partner has interest income, so we'll bring in the interest income. So once you add all this, then we are able to get the total taxable income for each partner. We get the total taxable income for each partner. Now this total taxable income which we've gotten, this is what we will subject to. So we'll subject to tax on graduated scale. So you apply the pay brackets on this income. That is how then you are able to assess the partnership for tax. Then once you've arrived at the pay amount, so assume we've arrived at the pay amount for partner A, partner B, partner C, we need to less now tax credits or tax paid in advance. So assume, like for example, the case of this withholding tax on the interest income. So we need to less, then we get the tax payable. This is now what is due on the accounts of each partner. So we need to less the tax paid in advance or the tax credits. So that is just an highlight on how to tax a partnership. In case of any question, you can leave a message you can leave a comment and we will be able to support you. So this is not tax advisory, but just sharing of information with respect to taxation of partnerships in Kenya. So subscribe to the channel so that you can benefit from more information like this. Thank you.